What are the tax implications when transferring property to an LLC? Have you ever wondered what happens to your taxes when you transfer property to a limited liability company? This is a common question among real estate investors. Let's break down the tax implications you should be aware of. First, let's talk about capital gains tax. If you are the sole owner of the limited liability company and it is treated as a disregarded entity, transferring the property usually does not trigger immediate capital gains tax. The Internal Revenue Service views this as a continuation of ownership. However, if your limited liability company has multiple members, the IRS may treat the transfer as a sale. This could lead to capital gains tax on any appreciation since you originally purchased the property. Capital gains tax rates can reach up to 20% for long-term assets, depending on your tax bracket. This tax is calculated based on the difference between the property's adjusted basis and its fair market value at the time of transfer. Next, consider transfer taxes and recording fees. Local and state governments may impose transfer taxes when ownership changes. These taxes are often based on the property's value and can vary significantly by location. Additionally, you may need to pay recording fees to file the new deed with the county. These costs can add up, so it is important to factor them into your decision. Another aspect to keep in mind is property tax reassessment. Transferring property to a limited liability company can trigger a reassessment of the property's value for property tax purposes. If the property has appreciated, this reassessment could lead to higher annual property taxes. Some states have specific rules regarding property tax reassessment when transferring property to a limited liability company, which can affect your estate planning strategies. Now, let's touch on mortgage considerations. While this is not a tax in itself, transferring property to a limited liability company may activate a mortgage due on sale clause. This clause could requiring you to repay the mortgage in full. This situation can indirectly impact your financial planning and tax strategy. You might need to refinance under the limited liability company's name, which could come with less favorable terms. Lastly, consider the potential loss of a stepped-up basis. When transferring property to a limited liability company, particularly if it is not disregarded for tax purposes, you might lose the benefit of a stepped-up basis upon inheritance. The stepped-up basis adjusts the property's cost basis to its current market value at the time of inheritance, which can reduce capital gains tax liability for your heirs. For practical application, transferring property to a single-member limited liability company is often simpler from a tax perspective. It avoids immediate capital gains tax and maintains pass-through taxation. However, transfers involving multi-member limited liability companies requiring careful tax planning to avoid triggering capital gains tax. Always consider state and local transfer taxes and property tax reassessment rules before making a transfer. Review your mortgage agreements to understand any potential due on sale clause activation. Using limited liability companies strategically in estate planning can help protect your assets and manage property tax reassessment, especially in states with high reassessment risks. Transferring property to a limited liability company can offer benefits, but it is essential to understand the tax implications to avoid unexpected costs.